Welcome to part 3 of our chapter 3 lecture series. This section will be on adjustments for depreciation. A special category of prepaid expenses is plant assets, which refers to the long-term tangible assets used to produce and sell products and services. Plant assets are expected to provide benefits for more than one period. Good examples of plant assets are buildings, machines, vehicles, fixtures. Depreciation is the process of allocating the cost of a plant asset over its useful life in a systematic and rational manner. At this point in the accounting process, we want to introduce you to a depreciation method known as straight-line depreciation. Straight-line depreciation is the most popular method used by companies. By determining the amount of annual depreciation, by taking the cost of the plant asset, subtracting the estimated salvage value, and dividing that amount by the useful life of the asset. The salvage value is the amount we expect to receive for the asset when we dispose of it at the end of its useful life. In a later chapter, we'll discuss other applicable methods of depreciation. For now, let's look at the adjusting entry to record depreciation. Formula for straight-line depreciation, asset minus salvage value divided by useful life. Useful life is a long-term asset is the period of time that an asset is expected to help produce revenues. Useful life expires as a result of wear and tear, or because it no longer satisfies the needs of the business. Salvage value. Salvage value is the expected market value or selling price of an asset at the end of its useful life. It's also called scrap value or residual value. Let's look at depreciation adjustment for fast forward. The company has purchased equipment on December 1st for $26,000. The equipment is expected to be worth $8,000 at the end of 5 years. They purchased the equipment on December 1st, but it is now December 31st. We will depreciate the cost now in December 31st. We will depreciate the net cost of $18,000 over its useful life of 60 months. In order to do that, the first step is the purchase of the equipment, $26,000, and we're going to have to depreciate that cost. So the $26,000 minus the $8,000 salvage, my net cost is $18,000. That is what I'm going to depreciate. The second step is to determine depreciation expense for this accounting period. 1 month is to use straight line formula. Net cost of $18,000, that is cost minus salvage, divided by 60 months of useful life. Remember that was 5 years. There's 12 months in a year, so that comes up to 60 months. Now we figure the depreciation for the month is $300. I have the 26 minus the 8 gives me the 18. 5 years, I'm doing it monthly, so 5 times 12, that gives me the 60 here. 18,000 divided by the 60. Every entry every month on this piece of equipment should be an adjusting entry for $300. The adjustment for the depreciation will look like this. We have posted the $300 debit to depreciation expense, and we have what we call a contra asset account accumulated depreciation. A contra asset account has an opposite normal balance or contrary to those of an asset. An asset has a normal balance of a debit, that's the side it adds on. Accumulated depreciation, being a contra asset, will add on the credit side. And when these two are put together on the balance sheet, it's going to get what is called book value. The journal entry, we debit depreciation expense for $300. We credit accumulated depreciation equipment, $300. Remember that accumulated depreciation is a contra asset account. It goes in the asset account underneath the equipment that it pertains to, but it has an opposite normal balance. When we look at our balance sheet, remember I told you that it would show up underneath that asset. When we subtract that asset from the equipment cost, we find out the book value is $25,100. Now this balance sheet is after February 28th. So $300 a month, that's where we get the $900 from. You will find out later there is something called the cost principle that does not allow us to change the price of an asset during the life of its asset until we remove it from the books. So this accumulated depreciation gives the reader of our balance sheet an idea of how much longer we will be using this particular asset. After the 3 months depreciation have taken effect, the equipment is now shown with a net accumulated depreciation of 25,100, and like I said, it's also called book value. This is the end of this part for the depreciation.